We saw Britain vote to leave the European Union in what's being termed as Brexit. How will it affect the world economy, interest rates, and our economy at home? That's what we'll discuss today. I'm Tim Sustak, and this is Naroff Notes. Joel, welcome back. It's great to have you here again.
It's always a pleasure, Tim.
So we saw Britain vote to leave the European Union, and I think that caught most folks by surprise. I think everybody thought they'd stay. They vote leave. So, in a grand scheme of things, what does it all mean?
Well, it did shock an awful lot of us. I can tell you this, I never expected it to happen, and I don't think most economists or most financial market analysts thought that that would occur. But what we've seen happen is really an issue of shock and the fact that it's created a lot of uncertainty. We saw it in the equity markets. Most people thought that the vote would be to stay. When it wasn't, we don't know what's going to happen going forward. Are other countries going to leave the EU? Will this be the start of the breakdown of the European Union? Or will it just be a one-off situation? I suspect it will be. I suspect that the European nations will make it very, very harsh on Britain as they leave, so other countries won't leave. But the problem is the uncertainty. Where do we go from here? That's affected the stock market, and we saw it so much in the decline, but once rationality began to take hold, we saw the markets come back, and I think there's a recognition it's not necessarily a huge impact, but it is a thing for uncertainty.
Right. Well, speaking of uncertainty and fear, wondering what it means for our Fed and rate increases going forward. I mean, we already have a Fed that seems very skittish as far as raising rates, and what does this do to their thinking and their timeline going forward?
Well, this has a tremendous impact. Nor has had a pretty good impact on interest rates itself. First of all, it's had a market impact. We saw it especially in the long-term rates. I mean, the 10-year rate getting down to almost 145 or even lower. I mean, as everybody, especially in Europe, got worried about what's going to happen, so they brought money into the U.S., and that drove down rates. But for the Fed, which is really seemingly looking for reasons not to hike, this has created enough uncertainty that now it's probably pushed back any rate hike at least one or two more meetings. The Fed doesn't want to move too precipitously. They don't want to do something that they shouldn't do. So this is an excuse not to, and it's raised a lot of questions about when the next move will be.
Right. So you think there's still time for them to get maybe one or two in this year?
I think it's a possibility. Keep in mind, even before the September meeting, there's going to be 3 more employment reports. We get a GDP report at the end of July that could show that the economy expanded by 3 or even 3.5% in the second quarter. We expect that job growth will come back if wages are coming up. We can go back to a situation where we were before Brexit, which really is not going to have a huge impact on the U.S. economy. Think about it. If we count up all of the exports to Britain, it's only 0.3% of 1% of GDP. If we lost 10% of those exports, it wouldn't even show up on the U.S. economy. So we could get to a point by the end of the summer or the fall where Brexit is behind us, but the U.S. economy is growing again. So I don't rule it out.
Okay. So assuming we do get that rate increase or two, and kind of just one final thought, is the U.S. economy strong enough to handle those rate increases?
I think the U.S. economy is strong enough. I mean, if we get the kind of growth in the second quarter that is shaping up, it's already looking, as I said, between 3 and maybe even as much as 3.5%. With the unemployment claims down, I suspect job growth, we had just a temporary slowdown. That's going to pick back up. Wages are accelerating. Confidence is coming back. I think we can accept at least 1 and possibly 2. I don't rule it out. It's not a high probability with a Fed that's looking for an excuse not to move, but I think the economy is strong enough to absorb it without really getting hurt a whole lot.
All right, great. Well, Joel, as always, appreciate you being here. Thanks for your time, and we always appreciate your insights on the economy.
Well, Tim, thanks for having me.
It's another edition of Naroff Notes. As always, Thanks for watching Fine Action.